Well, well-regarded value investor and Warren Buffett disciple Scott Black of Delphi Management told us back in December that he was buying infrastructure stocks ahead of President Obama's stimulus plan. But many of those stocks have struggled this year to date, as little of the funds have made their way to projects and these companies. Well, Scott joins us now from our bureau in Boston. And Scott, always great to talk with you. It's been a while.
Thank you for inviting me, Betty.
Okay, so these infrastructure plays have not done that well. I'm talking about Amron, Insteel, Jacobs, those guys. I mean, why stick with these plays?
Because, one, they have good backlogs, especially Jacobs, and we own Fluor, which just got a huge award for Afghanistan. Insteel selling below book value with absolutely no debt, and actually Amron is up a little bit, and they're the largest supplier of concrete culvert in the state of California, and beside the normal layoff problems, you have water conduit situation in California, and they're the big beneficiary. I know that they're going to desalination off of Carlsbad, but you're still going to need water carriers. And I do think that ultimately, out of the $787 billion stimulus, a portion of that really was targeted for infrastructure. Ultimately, it'll play through. It hasn't in the first 4 or 5 months, which has been disappointing, because the most important thing that President Obama could try to do is put people to work.
Well, then how confident, Scott, are you that that money will eventually flow through? I mean, how long are you giving it in these plays in terms of seeing that impact?
Well, we'll sit here for another 5 or 6 months. We've talked to every one of these companies recently, and actually both Jacobs and Fluor will have record earnings this year. The problem is that the backlog is falling off for next year, and there isn't great visibility at this point.
Well, without the stimulus money, though, I mean, Scott, what you're saying is that these are still good companies, they're still cheap to be in?
They are statistically cheap, but you're right, you do need the catalyst to boost them, and we haven't seen that catalyst to date.
Okay, Scott, let's talk about some of the other ones that you like outside of infrastructure. One is a retailer, and of course we're getting retail sales tomorrow. Buckle, a denim manufacturer, sales are higher, I think up about 30% for women. But sales, the men's sales are actually falling. Actually, they fell, I believe, last month. So why do you want to be in the retail space at this point when it seems quite volatile?
Yeah, but this company's had straight-up comps. They were up 9.4% in the last month. Total sales up 15%. The projected earnings for this year are about $2.70. It's an 11 PE. The stock does 30% on book, no debt, and over $4 a share in cash. They're well-positioned as maybe a Walmart or a Ross that they sell to the lower and middle markets. They're not high-end like Abercrombie or an American Eagle. And so I think it's a solid franchise, and they've continued to have quarter after quarter of record earnings.
But, Scott, in the retail space, do you want to go with the winners that we've seen so far as well? I mean, aside from Buckle, I mean, do you want to go with the Walmarts that have done well in this recession, or do you want to start picking a bit in a different area of retail?
Well, we go with the winners. I mean, this stock is an 11 multiple. It's pulled back from over 40 last year. It's been as high as in the mid-30s. It's under 30 again. I think it's a reasonable deal. The management was in town. I think they have an easy strategy to understand. They execute well. It's denim, as you pointed out, the bulk of it, and T-shirts, but it's aimed really at the middle class. They don't sell things like True Religion at the high end.
Okay. Scott, let's step back a bit and take a look at the broader space, the broader markets right now. You think we're I mean, I believe a few months ago when we talked with you, you thought the market was a bit rich. I mean, where do you think the markets stand right now?
Well, if you use a bottom-up estimate, we're at about 16 times expected earnings, and these are S&P's own figures. If you use some sort of a top-down, you're closer to 19 or 20. On either metric, the market's pretty full. And the other thing is we do quite a bit of mathematical screening, and we're finding there are very few companies that are cheap in terms of PEs at 11 below with sustainable earning power in this market. The market's been pretty well picked over since the 666 bottom on the S&P in March.
Well, do you think then that second quarter earnings season, as we get through it, is going to offer you any more guidance about where the markets are headed, where the economy is headed?
Well, unfortunately, a lot of the economy is hooked to public policy, and the public policy to date hasn't been wonderful. As I said earlier, job creation should be number one, and two, stabilizing the housing market was important as well. We don't go back to the TARP bill, and we probably should have restructured some of the mortgages to make them perform in terms of rescinding a portion of the principal. That hasn't happened. We have too much unemployment, and we have 23 million Americans underwater in negative equity in their homes, and that doesn't bode well for the recovery.
Well, then, Scott, in this earnings season, what are you going to be looking for in particular to tell you to enlighten you at all about what's going on?
Okay, what I look for is my own individual stocks to see if they have sustainable earning power. But obviously, we look at the bigger companies to see if there's any rebound, whether it's the large tech companies, financial service, companies where, there's been some cyclicality of late to see if there's any resurgence in their earning power.
Okay. Scott, great to talk with you as always. Scott Black of Delphi Management.